Hello, everyone, and welcome to episode 56 of the No Reservations podcast. This episode is titled The Restaurant Year-End Financial Checklist. And actually, for every small business, the year-end financial checklist will be super similar. And I'll go over that. So we'll just touch on what that looks like, what that means. If you've been in business for a while, you may know. Or there may be some surprising things in there. It's actually simpler than you might believe, or maybe accountants have made it out to be. So we're going to go over that. But then, in addition to that, I want to go over how you can use those numbers as you're closing your end, meaning you're cleaning up and closing the books of the year that you're in, how you can use that data to really, really, really help you in the following year. So first up, let's go over kind of a year-end financial checklist. Now, number one, of course, is to make sure that all of your accounts are accounted for within your accounting software, even if that's Excel, which I really hope it's not by now. But whatever accounting software you're using, all of the accounts that have touched your business should be on your balance sheet, and all of the activity within those accounts need to be in your books, which, of course, if it's on your balance sheet, the activity has to be on your books and done correctly. So what I mean by that, a lot by that, but one of the first things I'm thinking about is if you have any loans, whether it's a Toast loan, a third party, the merchant cash advance loans, traditional loans, lines of credit, whatever loan you have that you took out for your business, on behalf of your business, whatnot, that loan needs to be on your balance sheet, right? It's a liability. It's something you owe. And then the activity, the money that you took in, and the interest that you're paying, any fees, statement fees, annual fees, monthly interest, whatever, should also be accounted for, because you get the write-off for the fees of those. You certainly don't get to write off the payments you make back, but the write off the fees. You want all of that to be accurately recorded on your books and reconciled. Reconciled is actually an action. It's a thing that happens. It's not just a term that you use. I mean, it's a common thing that people can say, oh, I haven't reconciled that with my memory or something. Like it's I get that. It's like a verb you can use, but in accounting world, it's an actually thing that you do. And in QuickBooks, for example, and in any other accounting software that I've ever worked in, so I'm assuming they all have this, it is a button, a reconcile button that you push, and then it brings you into a reconciliation screen where you there have to check off all of the transactions that are actually on that bank statement or credit card statement or loan statement that needs to match what's in your accounting software, and you literally check them off until the balance is zero. The balance becomes zero is because you start with beginning balance, which QuickBooks will give to you if you've already had this account on your file, right? So your beginning balance, you enter in the ending balance, which is printed on the PDF statement that you get, and then you check off everything that actually happened within that account, and then that will come to zero if you've done it right. And then you hit complete reconciliation, and then this big green R, it depends what you're on, but like an R will show, meaning that that account has been reconciled, which is important. It actually kind of means everything when it comes to accounting, because when you hit that reconcile now and you get that R on that account, it means, hey, this account is legit. Everything in here is correct, presumably. Now, let me just have a little caveat there. We have seen some people who still hit reconcile, even though there are transactions that are appearing on the screen, let's say the reconciliation window, that they did not check off because they weren't actually on the statement and they didn't know what to do with it. And that is wrong. And so if that's ever the case, and I know I'm getting a little bit in the weeds here, so I'm going to back out of the weeds in just a second. But when you go to reconcile, and if you're jiving with me right now and you know that window comes up, and then on the left side usually are all your charges, your expenses, your checks, your ACH, whatever on the left side, and all your deposits, any type of deposits on the right side. If there's anything in that window that you don't get to check off because you don't actually see it on the statement. And if you checked it off, you'd be out of balance. That shouldn't be there, and you need to investigate that because it's wrong. And not only is it wrong, it means that there's activity happening within your books that's not correct. They're throwing off your numbers. So, and your numbers cannot be accounted for and they cannot be right. So that's why when you reconcile, it should be a clean slate until the next month happens. So that's number one. Of course, you want to reconcile. Well, number one is make sure that everything is on your balance sheet. Every account, that's bank accounts, that's any petty cash or cash on hand or cash in your safe, should be on your balance sheet. Any credit cards that you use on behalf of the business on your balance sheet. Any loans, lines of credit, third party, merchant cash, toast loans, all has to be reflected accurately on your balance sheet. And the activity goes in two places. It goes in the P&L, also goes in your balance sheet, depending on what it is. So make sure those are all there. You don't want anything missing. This is the full story of your business, and it's extremely important that it's on there. Then secondly, make sure every single one of those is reconciled just the way I described it, because that's how you know you can trust the numbers. You can trust the reports. They're accurate. So not only can you use them if you need future funding of some kind, but you can also get your taxes done accurately, and you can use them as a tool to go forward and make better choices. So that's the second part of the checklist, is make sure everything is reconciled. Thirdly, is this third? I'd say this is third because the reconciliation takes a big part of it. When it comes to payroll, and this is probably the biggest problem that we run into with onboarding clients, and then we clean it up and we fix it. But your payroll should match the quarterly and the annual federal payroll reports that every single payroll company gives to you. So quarterly, you get, it's called a 941. You get that every single quarter. And you want that gross wages on that quarterly report to match when you run a report quarterly in QuickBooks or whatever accounting software. They should match. This is really important because there's a difference between gross wages versus if you have a 401k or some other type of investment account going on with your payroll, or any type of reimbursements with payroll, certainly with tips on payroll. You want to make sure all of that ties out. And if you stay up on this quarterly by making sure you match those amounts to that federal statement that you get every quarter, it's going to stop you from having future problems. And this is one of the most common problems we see when clients are coming on board with us, is whether they were audited for those 941s or there's some type of weird tip discrepancy. And then you've got, hours and hours and hours of work to figure it out. Or God forbid, you have an employee that wants to come after you thinking they didn't get all their tips correctly or whatever. You want to dot your I's and cross your T's when it comes to the way that payroll is posted, and that includes the tip portion on your books. And if you just reconcile that to the 941 every quarter, then when that annual report comes out, which is a 940, it's a FUTA 940 report, you get that from your payroll company, then all 4 quarters should match. And then it's easy breezy, and you just keep doing that going forward. Super easy. That's what you want to do. Boring as heck. Yes, that's why we have work, because people don't like doing it, nor should you. If you're running a restaurant, you got bigger fish to fry there. But we want to make sure that we're doing that correctly. So that is, if you're working with a bookkeeper or an accountant, make sure that just ask them, are you tying out or are you reconciling to the 941s and then the annual 940? That'll save you so much heartache in the future when anything comes up. Payroll is just not something you ever want to mess with. It is highly regulated, as it should be, right? You're the trustee of that money that you owe to your employee. Highly regulated. Nobody gets any breaks. You want it done right, and it's worth it. So that's the payroll part. And the last part would probably be any outstanding AP. So vendor bills, you want to make sure those, if they're dated in the current year that you're in, so right now we're in 2026, that make sure those all get entered in so that you can actually, if you're running on an accrual basis, then you can actually see how you're financially doing. So let's go over that again. So make sure all accounts associated with your business are on the balance sheet and then they are reconciled correctly. Number 2 is making sure that all of those accounts, well, that is reconciled. Bank, credit card, loans, you name it, on there, reconciled. Number 3, that payroll is posted accurately in your books, from the wages to any overtime to the taxes to the tips to any retirement program, any reimbursements, whatever you have run through payroll, it needs to be tied out and accurately portrayed on your books. So that's like the biggest sweep. And then after all of those things are done, then the AP, making sure if you're on an accrual, if you're not on an accrual basis, that just means, well, an accrual means that you're going to file taxes and you're going to run reports based off of the date on everything, regardless if you paid something, if you received money, blah, blah, blah. It's the date of the invoice is what's going to be on your reports. A cash basis, that's the other way you can file and run reports, is it only matters when that thing was paid. When the money actually happened is when it matters. So most restaurants, maybe 60%, so not that much, but most usually do accrual. And that's because, well, there's a few reasons, but I would find as an operator, the main reason is because of New Year's Eve. And even the holidays, right? You're going to have a lot of bills leading up to the holidays, but you're probably not going to pay those bills until January, right? Because you might have 7, 14, 30-day terms. So they're going to get paid in January, but there are some big invoices coming in for December because of holiday parties, because of New Year's Eve, whatnot. If you are on a cash basis, and you pay those in January, then your January cost of goods is going to be completely out of whack, because my guess is you're not as busy in January as you are in December. And your December is going to look fantastic because you're going to have major sales coming in from all those holiday parties, New Year's Eve, etc. But you're going to have very little cost because those don't hit in January. That's why I don't like a cash basis for restaurants. If you do accrual, then it's the invoice date is what we're going to go by. And then your food cost is going to be much more, and your beverage cost much more accurate if we do it that way. So those are kind of the high strokes of how you close out or make sure that you're getting ready to close out your financial year end, and that you are working with accurate numbers, and then of course filing in a very accurate way. Now, if you are a restaurant that often is very profitable and then the owner owes taxes, that's unique. And first of all, congratulations, because you don't really see that a lot. So that's unique and it's great. There's a little bit more that you're going to want to do before December 31st to possibly mitigate the profit and therefore mitigating the tax liability. But I wouldn't go crazy. There is no point in spending money in December just to lower your tax burden unless you absolutely needed that thing. Like it's a waste of money. It's like saying, hey, let me go spend $10 so I can save $3. If you didn't need to spend the $10, then don't spend the $10, save the money. So it doesn't, that whole like, hey, spend all the money down to our accounts are zero on 12/31 to have better taxes, that's actually works against you in every way. And it's an old school, probably male dominated way to go. And I would not do that at all. So it's smarter to, if you planned on buying things in Q1 of the following year and you were looking really profitable, then that makes sense. Okay, maybe we should buy them in December because you were going to get them in the next month or two anyway. But beyond that, it's not worth it. All right, so then lastly, I wanted to go over how to use these financials. And the thing is, the kind of the theme throughout my book, Profit First for Restaurants, and the core message is the money is already there. So what I'm finding with all of the restaurant operators that I've had the privilege to work with over the last 2+ decades is they're always hoping for that next Saturday night. They want every night to be Saturday night. And they're always waiting for Saturday night to hit. So a lot of money will come in on Monday and Tuesday, and then they get to pay their bills. And it's like a dog chasing its tail. They do this over and over and over again, just waiting for Saturday night. And that's what gets you into a lot of problems. It shouldn't be about that. At this point, if we're closing your year, your business pretty much told you what it's capable of doing sales-wise. Is there room for growth? Yeah, let's hope so. That would be amazing if there is. But overall, the writing is on the wall, or it's on your report, so to speak, and your business is telling you, especially if you've been in business for a couple of years, maybe even the first year, maybe, it's telling you what it can do. So that's the money coming in. And use that as your starting point to plan for the following year. Just assume that that's what you're going to do. If you do more, which of course is always the plan, that's great. And that's just money's going to trickle down to your bottom line, and that's amazing. But let's not bank on it. Oh, pardon the pun there. But yeah, let's not bank on that you're going to do another 20, 30, 50%, because the reality is you might not. So here's the thing. Once your books are all done and you've done that financial checklist and everything is reconciled and everything is dotted and it looks fantastic, then I would run a P&L by month for that year. So right now we're in 2026, so run a January through December by month profit and loss with percentages. And that is your starting point to plan out pretty much everything for the following year. You'll know. It's probably the next best thing to having a crystal ball. It will tell you what you're going to do in January, for the most part. Can things change? Could there be wild snowstorms or crazy things happening or a competitor opening up next door? Obviously. But without anything extraordinary happening, January is telling you what January is capable of doing. And so is February. And so is March. So that's your starting point. You already have those built in for you. So now if you take those numbers, right? So if last year you did, for easy numbers, you did $100,000 in January. That means, and you need to run a 30% food and beverage cost, and you need to run, let's say, a 35% in payroll. That's what? Just multiply that out. That's $30,000. And that is your budget for purchasing food and beverage. So plan your purchasing, plan your menu around that, plan your specials around that, plan your sales strategy around that. You can even work in your marketing strategy around that. And the same for labor, and even more so, because this is where we find most restaurants are struggling right now, is keeping the labor down. So now that we know, if you want to run 35%, now you have a budget of $35,000. Divide that by whatever, 4 or 5 weeks, you determine how you want to do that. So if we do it by 5 weeks, again, for easy numbers, that's $7,000 a week in payroll. How are we going to divvy up that $7,000? What's going to go to management? What's going to go to the chef? What's going to go to the front of the house? What's going to go to the back of the house? That's your starting point. That's where the creativity can step in and say, how are we going to make this work? And do that for every single month or every quarter, but I like to do it monthly going forward. Remember, the money is already there. Your business is telling you what it can do. It's telling you what it's probably going to do. So let's just make money doing that. And if you can increase it, great. And that's another podcast episode and things you can do to increase it. But let's not just hope that it's going to increase, which is what we see day in and day out. Oh, I think it's going to get better. Oh, we're going to run this ad. Oh, we're going to do this. No, let's work with the crystal ball that we're given, which is your year-end financials, and use those by month. And then what's great about it, it kind of gamifies it. So then we can compare to, as you get into the following year in January and February, compare it to last year. Super easy to do in any accounting software, and see where you knocked it out of the park, where you missed the mark, and those are the adjustments that you might want to start making. So I think that's a wrap on episode 56, because this is not usually a topic that a lot of my operators love to talk too much about, and we're approaching the 20-minute mark. So that's all I'm going to say about the year-end financial checklist for restaurants. Let me wrap this up by saying this. Bookkeeping, accounting, but I'm going to start. Bookkeeping is not a luxury for restaurants. It's not something, hey, if we have extra money, maybe I'll hire some cheap bookkeeper. It will make you money if you have the right bookkeeping team in place. And there are lots of great bookkeeping companies out there, and many specialize in restaurants, just like we do at Spark. But there are others. I'm not here to just tell you have to work with Spark. There are plenty of others, but you're going to want to find one. It is money well spent. Your bookkeeper should help make you money. They should help guide you into making the right decisions. If your payroll keeps inching up over 40% and you just can't figure it out, a bookkeeper that specializes in hospitality should be able to have a conversation with you and kind of brainstorm some ideas, because we've seen it done in all these other restaurants that we work with, and we can take some of those ideas and throw it against the wall with you and say, hey, have you tried this, 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 or this? We've seen these things work. We've seen these things not work. That's what a great bookkeeper that niches down in your industry can do for you. They are a partner for you. They can help make you money. So, all right, that's a wrap on episode 56. As always, thank you so much for listening. If you could like, share all the things that you do with podcasts, that would be huge for us to help get the word out to other restaurant operators that we really are hoping to help. And until next time, thanks so much. Have a great day.